In 1965, a 35-year-old investor bought a failing textile company for $8.6 million. Today, that same company is worth over $700 billion, making it one of the most valuable corporations on Earth. The man behind this transformation? Warren Buffett. But here's what most people miss. Buffett didn't become the world's greatest investor through complex strategies or insider information. He did it with one simple mental model that rewired how he thinks about everything. Today, you'll discover the exact psychological framework that turned a middle-class kid from Omaha into a $100 billion fortune. And more importantly, how you can apply this same mental model to transform your own financial future. Welcome back to The Wealth Mind, where we decode the psychology behind prosperity. Warren Buffett's story isn't just about making money. It's about completely rewiring the human brain for long-term success. While most investors chase quick profits and daily market movements, Buffett developed what psychologists call a metacognitive framework, a way of thinking about thinking itself. This mental model has three core components, and by the end of this video, you'll understand exactly how to implement each one. But first, we need to understand where it all began. Warren Edward Buffett was born in 1930 in Omaha, Nebraska. His father, Howard, was a stockbroker and congressman. But here's the crucial detail most biographies skip. Young Warren didn't just inherit money, he inherited a completely different way of thinking about money. At age 6, Warren was already buying 6 packs of Coca-Cola for 25 cents and selling individual bottles for 5 cents each. But the psychology behind this wasn't about making money, it was about understanding value creation. By age 11, he had bought his first stock, 3 shares of Citi Service Preferred. The stock immediately dropped from $38 to $27. Most kids would have panicked. Most adults would have sold. But Warren held. When the stock recovered to $40, he sold for a small profit. Then he watched in horror as it climbed to $200. This moment crystallized what would become his signature mental model, the psychology of patient capital. Most investors learn to be reactive. Warren learned to be strategic. While others were focused on stock prices, he was studying business fundamentals. While others worried about daily fluctuations, he was thinking in decades. This wasn't natural talent, it was trained psychology, and it all stemmed from one encounter that would change everything. In 1950, a 20-year-old Warren Buffett discovered a book that would rewire his brain forever. The Intelligent Investor by Benjamin Graham. But it wasn't just the investment strategy that captivated him, it was the psychology. Graham taught something revolutionary. The market isn't rational, but human behavior is predictable. Warren immediately applied to Columbia Business School to study under Graham. When he was initially rejected, he didn't give up. He wrote letters, made calls, and eventually talked his way in. This persistence would become a hallmark of his mental model. Graham introduced Warren to 3 psychological concepts that most investors never master. First, Mr. Market Psychology. Graham taught that the market is like an emotional business partner who offers to buy or sell your share every day. Sometimes he's optimistic and offers high prices. Sometimes he's depressed and offers low prices. The key is to use his emotions, not be controlled by them. Second, margin of safety thinking. Don't just buy good companies. Buy them at prices so low that even if you're wrong, you won't lose money. This isn't just financial strategy. It's psychological protection against cognitive overconfidence. Third, circle of competence discipline. Only invest in businesses you completely understand. This prevents the psychological trap of FOMO, fear of missing out on exciting opportunities outside your expertise. But Warren didn't just learn these concepts. He internalized them at a psychological level. He trained his brain to think differently about risk, time, and opportunity. When he graduated, Graham offered him a job at his investment firm for free. Warren was so eager to learn the mental model that he was willing to work without pay. This decision would compound into billions. By 1956, Warren had developed what he calls his mental model, a systematic way of thinking that eliminates emotional decision-making and focuses purely on logic and probability. Here's how it works. Component 1, 20-slot thinking. Warren imagines he has a punch card with only 20 holes for his entire investing lifetime. Each investment decision uses one hole. This mental constraint forces him to only make decisions he's absolutely certain about. The psychology. This combats the human tendency toward overactivity. Most people make too many decisions because action feels productive. Warren trained his brain to see inaction as equally valuable. Component 2, 10-year thinking. Before any investment, Warren asks, would I be happy owning this company if the stock market closed for 10 years? This question eliminates short-term noise and focuses on fundamental business quality. The psychology. Our brains are wired for immediate gratification. By forcing 10-year thinking, Warren bypasses the neurological circuits that cause impulsive decisions. Warren only invests in businesses he completely understands. When the dot-com boom happened in the 1990s, everyone called him outdated for avoiding tech stocks. But he knew his psychological limitations. He couldn't accurately predict tech company futures. The psychology. This protects against the Dunning-Kruger effect, the tendency to overestimate our knowledge in unfamiliar areas. But here's where it gets fascinating. Warren didn't just apply this model to investing. He applied it to everything: hiring decisions, business partnerships, even personal relationships. This mental model became his entire approach to life. Here's the most important part. Warren's mental model created what psychologists call a compound effect, not just in his investments, but in his thinking itself. The Coca-Cola case study. In 1988, when Warren was 58, he invested $1.3 billion in Coca-Cola. Wall Street called it crazy. The stock seemed expensive, and the company was facing increasing competition. But Warren's mental model saw something different. He asked his 3 questions. 20 slot test. Was this one of the 20 best opportunities of his lifetime? Yes, a global brand with an economic moat. 10-year test. Would he be happy owning Coca-Cola if markets closed for a decade? Absolutely. People would keep drinking Coke regardless of stock prices. Circle of competence. Did he understand the business? Completely. Simple product, predictable demand, strong brand loyalty. The result? That $1.3 billion investment is now worth over $25 billion. But here's the psychology lesson. Warren didn't get lucky. He created a mental framework that consistently identifies undervalued quality. The See's Candies lesson. Earlier, in 1972, Warren bought See's Candies for $25 million. It was only generating $4 million in annual profits. By traditional metrics, he overpaid by $20 million. But his mental model saw the psychology of consumer behavior. See's had what he calls an economic moat. Customers would pay premium prices because of emotional attachment to the brand. Over the next 50 years, See's Candies generated over $2 billion in profits for Berkshire Hathaway. A $25 million investment returned 8,000% because Warren understood the psychology of consumer attachment. This is the power of his mental model. It doesn't just help you avoid bad decisions. It helps you recognize extraordinary opportunities that others miss. So how do you apply Warren's mental model to your own life? Here are the 3 practical steps. Step 1, create your own 20-slot system. Whether it's investments, career moves, or major purchases, limit yourself to only the decisions you're most confident about. This forces you to research thoroughly and think long-term. Step 2, implement 10-year thinking. Before any major decision, ask, will I be happy with this choice in 10 years? This eliminates impulsive decisions and focuses on a sustainable value. Step 3, define your circle of competence. Identify exactly what you understand deeply and stick within those boundaries. It's better to be excellent in a narrow area than mediocre in many areas. Warren Buffett's $100 billion fortune wasn't built on luck, insider information, or complex strategies. It was built on a simple mental model that anyone can learn: patience, selectivity, and staying within your competence. The most powerful part? This model gets stronger over time. Every good decision reinforces the framework. Every avoided mistake builds confidence. Every year of patience compounds into wisdom. Warren once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." His mental model is that tree, and today you can plant your own. If you want to think like the world's greatest investor, subscribe to The Wealth Mind for weekly psychology insights that transform how you think about money.